risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to retain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is, how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up. Should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be.
Do you hear me if I speak like this?
More about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through.
The crazy thing is, Bratans, he's speaking about the labor market, which is very strong, but the labor market is just delaying, So this is the crazy thing, because the labor market, yes, it's obviously strong, but right now, as the companies start to feel, that the loan is getting more expensive, so they will start to make shortages on the employees, and then we will see that the labor market is breaking down. So it's only a question of time. He's just telling, it's exactly like I told you, Bratans, exactly like I told you, that right now they hike the rates. Wait a minute, I turn them off quickly, or make it. You hear me, right? They increased by 0.75%, so by 75 basis points, and they're telling this because on the 8th November, like I told you in the videos today and yesterday, because in the 8th November is midterm election, and they want to present a very healthy market. Okay, we're getting everything under control. The labor market, like he said right now, is very, very good. But in real, it's not good. It's just will present it to you so that they collecting voters, right? That the Democrats win on the 8th and on the midterm election. You understand what they're doing? But however, I mean, we see the market pumped amazingly. I mean, yeah, right now it's dumping again. Wait a minute, I have to watch on the screen. Yeah, the crypto market pumped heavily to 20,800, and it depends right now what he's telling further right now, if it's more pumping or if it will dump. So I'm expecting still that we will see here another pump. However, let's see. But until now, everything perfectly working out like I explained to you, right?
Job openings, what do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. we're getting really nothing in labor.
You see this unemployment thing, what he's speaking about, this is exactly what I'm telling you, it's a delay. It's only a matter of time when also the labor market, what was considering the unemployment, will go heavily up the unemployment. It's only delayed right now.
Well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see. Vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually was through that.
You hear me, Bratan? Yes. Blah blah blah. You see, we are still here in this rising wedge. This is the dollar DXY. We are still in this rising wedge, and yes, we had here like we could say it's a fake out, right? And you see, as we dumped here, as the dollar dumped, Bitcoin pumped. Right now we are back in this rising wedge, and still the likelihood that we are breaking down is more likely than that we are breaking to the upside, right? Because it's a bearish pattern. And what it means still that even though we are back in this rising wedge, it still means it's still more likely that we are breaking down and we see Bitcoin pumping, right? However, it's not a guarantee. I still in my long position, Bratans. You see, we are still retesting the whole time here this yellow line, or we are here in this area between 20,350 and 20,530 approximately. So in my opinion, it's only a matter of time when we see Bitcoin pumping, because we are in a very, very clear rising wedge on the DXY, on the dollar. And the crazy thing is also the S&P 500 looks very healthy. Why? Because yes, we saw here this dump right now, right? But the thing is, look at the RSI. The RSI is slightly, or is oversold on the 1 hourly, 15 minute we are heavily oversold, and 4 hourly getting right now neutral. So it looks very healthy. And even though if we are or even if we're breaking down here to this purple line, which would mean obviously Bitcoin will break to 19,500 or something like that, even then we would be very, very bullish if we're bouncing back on this purple line. The only thing is, what should never happen, that we are breaking below this purple line. This will be very dramatic for the S&P 500 and S&P 500's leading indicator. Then we would see also a breakdown in the Bitcoin price, right? I told you when we, if you're watching my videos, if you subscribe to my channel, I told you weeks ago that if we are breaking here this purple line to the upside, we will see a pump in the S&P 500, and this is what we saw, and then we see also pump in the Bitcoin. And the nice thing about it is you see exactly the same thing happened also on Bitcoin. If we're zooming out here on the daily, we broke out, S&P 500 broke the purple line. We broke also out here of this descending broadening wedge, which is a bullish pattern. And technically the price target is still valid. Technically the price target is still here around 26K. So it's 100% and still valid, even if we are dumping here, even if S&P 500 cooling down, even if we are dumping to 18,400, still the price target would be 26K, and it would be still healthy. Here only the one thing is, if we're breaking back into this descending broadening wedge, then I'm expecting Bitcoin to see here around 11,600. I mean, depends on timeline, but yes. But I don't expect, I cannot imagine that we will break before the 8th November, breaking down to 11,000. Yes, in the bigger picture, in the really huge picture, expecting that Bitcoin will go even here, this orange line you see, this is the orange line back from 2016, 6 years ago. You see here big, I mean, you don't see it, maybe I have to extend it a little bit. Wait a minute. You see here, it's a line from, wait a minute, it's a line from 2016, huge resistance, here support, support, support. So I'm expecting in the big picture, in this bear market, I'm expecting that we will see Bitcoin around between 6 or 7K. This will be the bottom. The bottom is not in, but at this time we could see, you see here this purple line was a huge resistance line. I'm expecting here that we could easily see pump here to around 30,000, 33,000 before we see a dump to 6 or 7K. Obviously, you could see also the opposite. We could first dumping to 6, 7K and then jumping to 36K. But in my scenario, most likely we are going to 33K and then see a dump to 6K. I mean, the pump, like, because for sure people saying, oh, Slavik, it's not possible. It's only a pump from here to 32%. It's only a pump of 50%. Look back on the bear market. Look which pumps we had. Look which pumps we had before you crying me here the floor full in my live stream, in my comments. Look at this, we had here a pump of over 300% the previous bear market before we fall down again back to nearly 4K, nearly to the bottom, right? So therefore, this could easily happen in the big picture. However, in the midterm, I'm expecting here, or in the immediate short, not mediate short term, on short term, I expect that we will go to 26K before the 8th November, because 8th November is midterm election, and I don't think that their interest is to dump the market right now, because they will not collect the voters, right? And we see the S&P 500 looks very healthy, in my opinion, right now. Even though we saw right now a dump, we are perfectly here on this support zone. So in my opinion, this looks at the moment everything very healthy, and the proof of this is that they raised only by 0.75%, and you see right now Bitcoin is pumping again. So this looks amazing, bratans. In my opinion, I can show you also my wait a minute, I make also Ethereum. I can show you also my trade. Wait a minute, my trade is right now 40% in profit. Wait a minute, I make a little bit bigger. I make you bigger than Logan Paul. So my trade is right now 42% in profit, 42% profit, $150 in profit. I made this before because for me it was very clear Like I told you, Slavik is right, not first time I hear about TA, he explains. Thank you very much, Bratan. So for me, it was quite obvious and expecting further pump because in the big picture, like I told you, we broke out of this descending broadening wedge. You see here, we broke out of this descending broadening wedge, and I still very sure we'll reach 26K, even though if we maybe see a break to 80,500. Maybe we see something like, you know, here like a consolidation, a pump to 22K, and then retesting here this line even at 18K, you know, before we see again a pump to 26K. It could happen as long as we're not breaking down this white line to the downside. It looks very healthy, and I'm very confident we will reach something between 25,800 26K. So in the very immediate short term, I'm expecting that we will see here Bitcoin going to 21K. So this could be a trade of around, for now, of around, wait a minute, I mean this white line at around 21,100 even, of 2.5% and exception. 25% to index average over 50%. Obviously, if we are breaking here this yellow line to the downside, in my opinion, you can switch to a short. Not a financial advice, in my opinion. If we are clearly breaking down below this yellow line, I would say here around 20,240, we can start to short down to 18,700, approximately 7.5% short opportunity, index average 75 to index average 50% short opportunity. And if we are watching right now Ethereum, Bratans, if Bitcoin further pumping, then I'm expecting we can, and Bitcoin is pumping, I'm expecting here Ethereum reach our high at 1,636, and I'm expecting that we will reach at least 1,720. So 9%, 90, 20, 180% long opportunity, but only if Bitcoin also pumping. If Bitcoin dumping, I'm expecting that we will reach 1,285. $1,285. It's 18% thanks to 180%, 20 360%. Only if Bitcoin dumping. Obviously, we have here some price targets in between, like 1,550 and 1,500, but I don't want that it's getting too boring right now. So the dollar, yes, could a little bit more pump here. You know, we could see it could pump here to 112, then 111, then again 112, and then I'm expecting here dump because we are in a very clear bearish pattern, Bratans. I don't expect here a pump, and if the dollar is dumping, we will see Bitcoin is pumping, blood. Hojak. This is what I'm expecting. In my opinion, this is very clear because also S&P 500 looks very, very healthy. Like I explained to you here, S&P 500 looks very, very healthy. Wait a minute, blood. Where is it? Where is this? Wait a minute. Delete, blood. Because RSI looks right now very healthy, even though if we see a little bit more dump. You see also here, this line is a very, very big support line. You see here around approximately this line. Why it's a big support line, you see here previous support and resistance, support and resistance, support, and here turns also into support. So very, very clear. If we break this line to downside, next price up 3,730, then we would see obviously a breakdown also on Bitcoin. So watch out for this. This is what I'm watching, but in the big picture, I'm still expecting here pump. However, not a financial advice, do your own research. I'm not a financial advisor, Bratans. I only show what I'm doing. If you also want to trade on BitGet or Bybit, link is down below. You can get up to $8,000 bonus on BitGet if you match the requirements, Bratans. So, I mean, very clear in my opinion. Write me, what do you think about it?
Has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent...
Did you hear me what I told you, Blad? Or are you joking, Bradan?
To see the path, it's narrow. I say the path is narrowed over the course of the last year. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to, ordinarily there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's always law. all those things are relationships that are in the data, and they're very real. It is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Now you hear me, right? I don't know why a lot of you writing it's very, very bearish. I don't see here anything very bearish. Like I explained to you, I see it very bullish. Everything in the immediate short term, yes, in the bigger term, we will see Bitcoin to 7 or 6K, but right now in the immediate short term, dollar is in a rising wedge. We saw some fake out here. We saw some fake out to the downside. But I'm expecting here from this rising wedge that we will break it down. It's more likely than to break it out because it's a very, very clear bearish pattern. S&P 500 looks also very healthy. So here we have a very huge green volume coming in. I don't know why you see it so bearish. So I still in my long position right now. Bratans, I don't know why you see it so bearish. Write me. What do you think? You hear me, right? Write 1 if you hear me, bratan. 1, 2, 3, 1, 2, 3. Жопа pada 3. Why is the chat so... My chat is hanging, bratan. Please write me, what do you think? Yes, I think Slavik that, yeah. Yes. So, bratans, I hope you understand what I explained to you. In my opinion, very clear. Yes, yes. Yes, but very low. Okay, so you understand. Good. So in my opinion, let's wait. Let's see what is happening here. If we're clearly breaking here below this... Oh, jopta mine. Just pumping there. This son of a bitch. Dollar is pumping. You see dollar is pumping, Bitcoin is dumping. You see, it's always connected. But in my opinion, this is a trap. You see, yes, dollar is pumping, and it will retest probably this line. But as long as dollar not breaking above this line, I expecting that the dollar will dump, breaking down, and Bitcoin will pump. So in my opinion, this is only fake out. It's only trap from the dollar side, and as long as we're not breaking here clearly below, I would say clearly below 20,000, let's say 20,300 to the clear 15-minute candle, I would not jump into a short. In my opinion, this is very clear, still long opportunity. Only my opinion, even if we break below 20,600, or only if we break below 20,066, I will go into a short with a clear 15-minute candle, because dollar is in a very clear bearish position. S&P 500 looks very healthy still, even though we see right now dumping, yes, but here's a big support. We have here big support. We have here big support, and here this purple line. So in my opinion, it's only everything cooling down, which is still very healthy. Also on the 4 hourly, we see RSIs cooling down. 1 hourly getting oversold, 50 minutes heavily oversold. So I expecting here to see a pump, bratans. This is my opinion, not a financial advice. Please do your own research. I'm still in my long position. I will switch if we're clearly breaking below 20,066. Then I will jump into a short. As long as then I will stay into a long, bratans. In the big picture, like I told you, I don't expect here to see, in the big picture, expecting this is not at all the bottom. The bottom will be between 6 and 7K in my opinion, bratans. So thank you everyone for watching, bratan, that you watch with me together here the stream. I kiss you and I see you later. Mwah. And if you don't forget, if you want Telegram group, free access, make sure you trade through my affiliate link on buy